Last year here on Business Weekend, we explained massive impending changes to accounting standards that incorporate sustainability reporting, including climate risk. For some public companies, especially heavy carbon emitters, it could mean being forced to significantly write down the value of their key assets. Any changes, of course, will be the subject of intense debate, especially about which assets are most vulnerable and therefore need to be written down the most. Now, 20 peak Australian professional, industry and investor bodies have come together to prepare a joint submission for the International Sustainability Standards Board. The person who corralled together those organisations is Karen McWilliams, Business Reform Leader for Chartered Accountants Australia and New Zealand, who I spoke with a little earlier. Karen, you and I spoke in November last year about exactly this issue. Clearly, a lot of work has been done to get all of these organisations together to at least agree on the submission that will go to that International Standards Board.
Yeah, so we've, I guess since we spoke, the International Sustainability Standards Board has put out 2 exposure drafts looking at general sustainability standards and also specifically disclosures around climate risk. And I suppose we then spoke together thinking that we would have more impact if we could bring together the voices of the preparers, the professionals and also the users. And if we could all agree on what our feedback was on these draft standards, then that would be far more compelling to the standard setters and the regulators, I guess both internationally and domestically.
OK, so just explain to where it's gone to since we last spoke. Is it a situation now where more Australian companies, because we're in a reporting season now, are going to make allowances or assume risks on assets? And I mean, some of the big ones that we've seen quite clearly are some of the big power generators here in Australia with coal-fired power stations. And there's been controversy about the value of their assets now and in the future and their ability to attract capital.
So what I think we've definitely seen in the last few years is definitely an increase in Australian companies, particularly the listed ones at the larger end of town, disclosing in line with the Task Force for Climate-Related Financial Disclosures, the TCFD. And the draft standard that's come out of the ISSB on climate is based around the TCFD. So there's a lot of alignment there. So we've certainly seen that, and we probably expect to see an increase again in this reporting season of more entities both reporting in line with the TCFD, but I guess also probably those who are already doing it, probably enhancing their disclosures and building them out.
So what we've seen, though, quite clearly, is a lot of companies embrace, say, some sort of net zero by 2030, net zero by 2040, whatever it might be. A lot of companies have already started down that path. Do these standards also say anything about greenwashing? Does it make it more difficult for companies to make these claims and then not back them up by action?
I think, look, it will bring some credibility and some comparability to the climate disclosures. It's particularly focused on risks and opportunities. It includes things like scenario analysis and also metrics and targets. So I think it will provide some of that basis for companies to, I guess, say whether their commitments are going to stack up, and also for investors to say, OK, this is the impact that climate is going to have on your strategy, and how are you adapting that to deal with, I guess, your commitment to net zero, and what are you changing? So whilst it isn't necessarily going to totally match the two up, I think it will provide that basis to enable better disclosure and better comparability.
Because then it also gives investors and bankers and employees and others an ability to look at a company to see what action they might be taking, to see whether they're having to mitigate or whether they can actually change behaviour inside that organisation. Some of this stuff can cost because, again, investors are going to have to weigh that up along the line as well, aren't they?
Yeah, exactly. And we're certainly seeing investors taking a strong interest in wanting this information, wanting comparability and consistency in the information from companies. And as you say, the other thing we're going to see is because banks and insurers and other companies are looking at their own disclosures, that then flows through the value chain. So they're actually going to need to we're going to need to see disclosures or at least emissions reporting from other companies, perhaps smaller, who are part of that value chain to actually inform the disclosures of the larger companies.
Karen McWilliams, always good to have you in the program from Chartered Accountants Australia and New Zealand. Many thanks for your time.